People like to think the market beats them because it's cruel or because someone else knows more. That's not it. The market doesn't care enough to be cruel. What beats most traders is much simpler than that. It's the hand that clicks before the mind has finished its sentence. I've seen it 1,000 times, mostly in myself. An impulse click is nothing more than a confession that you stopped thinking again. And when you stop thinking in this business, you start paying tuition. I learned early that the tape doesn't reward activity. It rewards judgment. Yet judgment is the first thing that leaves the room when price starts moving fast. The chart twitches, the candle stretches, volume perks up, and suddenly your finger is already hovering. Ever notice how quiet your rules become at that moment? You wrote them down, you reviewed them, you swore by them, and still there you are, about to act as if none of it mattered. Why is that? An impulse click feels like action, and action feels like control. But most of the time it's just fear wearing a confident coat. Fear of missing a move. Fear of being late. Fear of watching price run without you while you sit there pretending to be disciplined. The market knows this fear well. It has been harvesting it since the first man tried to speculate with borrowed money. And it never gets full. I used to think the hard part of trading was finding the right setup. That's what beginners obsess over. Indicators, patterns, secrets. But the market taught me otherwise. The hard part is waiting while nothing happens. Then doing nothing while something almost happens. Can you sit on your hands when the chart is tempting you? Can you watch a level get close without convincing yourself that close enough counts? Ask yourself that the next time your pulse picks up. The chart doesn't ask you to predict. It asks you to observe. Price either behaves the way it should or it doesn't. That's not philosophy, that's arithmetic. Yet impulse clicks come from arguing with what's right in front of you. You see a breakout forming, but it hasn't broken. You see support nearby, but it hasn't held. Instead of waiting for proof, you trade the hope. And hope, in speculation, is a bad substitute for cash. Every impulsive trade has a story behind it. It looks strong. It's about to go. I'll just take a small position. I've told myself every one of those lies. The trouble is, the market charges full price even when you say, just. There's no discount for trades taken without thinking. The commission doesn't shrink because you were excited. The loss doesn't soften because your intention was good. A trader's real enemy isn't volatility. It's impatience. Impatience is what makes you trade inside the noise instead of waiting for the signal. It's what makes you read meaning into random bars. The chart becomes a Rorschach test, and you see whatever justifies the click you already want to make. Have you noticed how convincing the chart looks right before a bad trade? Sound money management doesn't begin after you enter. It begins with deciding not to enter. That's something no one likes to hear, because it sounds passive. But there's nothing passive about restraint. Restraint is work. It takes more strength to stay flat than to be wrong. Being wrong at least gives you something to do. Manage, adjust, hope. Staying out leaves you alone with your thoughts, and that's uncomfortable. Impulse clicks also come from a misunderstanding of opportunity. The market offers endless chances, but not endless good ones. If you believe this is the only trade today, you'll grab it. If you know another one will come when conditions are right, you can afford to wait. That belief isn't optimism, it's experience. And experience is expensive if you insist on learning it the hard way. I learned to treat every trade like a business decision, not an emotional reaction. A businessman doesn't buy inventory because he's bored. He buys because the numbers make sense. In trading, the numbers are price, volume, time, and risk. If one of those is missing, the deal isn't complete. So why sign the contract anyway? Just to feel involved. The tape speaks plainly, but it speaks slowly. Impulse traders try to finish its sentences. They think they know what the next bar will say. But the market doesn't reward anticipation, it rewards confirmation. The big moves don't require speed. They require patience and courage. The courage to wait, and the courage to act only when the evidence is there. Can you tell the difference between courage and impulse when your money is on the line? Wealth in trading is built the same way it's built anywhere else, by avoiding stupid losses. Big wins are memorable, but small, unnecessary losses do the real damage over time. Every impulse click is a small leak in the account. One leak doesn't sink the ship, but enough of them will. And the worst part is you don't notice the water until it's at your ankles. The disciplined trader doesn't feel smarter than the market. He feels patient with it. He lets price come to him. He waits for the chart to prove itself, not for his emotions to calm down. He knows that being flat is a position, and often the best one. When he finally clicks, it's not a release of tension. It's a decision already made long before the mouse moved. Impulse clicks are not a lack of knowledge. They are a lack of respect for your plan, your capital, and the market's ability to humble you. The cure isn't more indicators or faster screens. It's learning to pause, to ask one simple question before every trade. Has this trade earned, or am I just tired of waiting? The mouse click is cheaper than thought, and far more expensive than patience. That's a line the market teaches you quietly, invoice by invoice. No alarm sounds when you click too fast. No voice warns you that you just paid for something you didn't need. All you hear is the soft tap of a button, and it feels harmless, almost polite. But the market has never charged by the noise of the action. It charges by the quality of the decision behind it. A click costs nothing in the moment. No effort, no waiting, no discomfort. That's why it's dangerous. Thinking, on the other hand, costs time. It costs restraint. It costs you the uncomfortable feeling of watching price move without you. And patience costs even more. It costs your ego. Can you sit there while the market tempts you and still do nothing? That's the real price most traders refuse to pay. I've learned that most bad trades feel good at the start. That's the trick. The click gives you relief. It ends the waiting. It quiets the voice in your head that keeps saying, "What if it goes without you?" But relief is not profit, and silence is not confirmation. The market doesn't reward you for calming your nerves. It rewards you for being right at the right time, and those two things rarely happen together. When a trader clicks without thinking, he's buying speed instead of accuracy. He wants to be early, not correct. Early feels intelligent. Early feels sharp. But early is often just wrong with confidence. The market has no interest in how quickly you acted, only in whether price agrees with you afterward. Have you noticed how little the market cares about your urgency? Patience looks expensive because it shows you what you're missing. Every bar that moves while you wait feels like a loss, even though you haven't lost a cent. That illusion pushes traders into action. They mistake unrealized opportunity for real damage. So they click just to stop the feeling. And that's when the real damage begins. A thoughtful trade has weight to it. It doesn't rush. It doesn't beg. It sits there justified by structure, supported by volume, aligned with the broader move. An impulsive trade is light. It floats on hope. It depends on the next tick to validate it. Which one do you think the market respects? I've watched traders blow good weeks in a single afternoon, not because the market changed, but because their patience ran out. They paid for cheap clicks over and over again, thinking each one was small. But small costs repeated without thought become large expenses. The market compounds mistakes just as efficiently as it compounds gains. Thinking before clicking feels slow, but it's the only thing that speeds up your progress long term. Every time you pause, you're training yourself to see clearly. Every time you wait, you're protecting your capital from trades that were never yours to take. And capital is opportunity stored. Waste it, and the future shrinks. Guard it, and the market stays open to you. Most traders believe discipline shows up after the trade, in how they manage it. That's backward. Discipline shows up before the click, when nothing forces you to act. Once you're in, the market is in control. Before you're in, you still have the advantage of choice. Why give that up cheaply? The patient trader doesn't feel clever. He feels calm. He doesn't need to participate in every move because he understands that missing trades is part of trading. The impulsive trader feels busy. Busy looks productive, but it rarely is. The tape doesn't pay salaries for effort. It pays dividends for judgment. Every click should represent a conclusion, not a question. If you're clicking to see what happens, you've already admitted you don't know enough to be there. The market is not a laboratory for curiosity. It's a courtroom. Evidence first, action second. Anything else is gambling dressed up as analysis. Patience isn't waiting for the market to do something exciting. It's waiting for it to do something clear. Clarity rarely arrives with fireworks. It comes quietly, often after most people have lost interest. Can you stay attentive when the excitement fades? The cheapest trades are the ones you don't take. They cost nothing up front and save you from paying tuition later. Every avoided impulse is money kept, confidence preserved, discipline strengthened. But those savings don't feel like gains, so most traders ignore them. They chase what feels like progress instead of what actually builds it. If you study your worst trades honestly, you'll find they were rarely complex mistakes. They were simple ones made quickly. You knew better, but you clicked anyway. Not because the setup was perfect, but because waiting had become uncomfortable. That discomfort is the price of patience, and it's the only price worth paying in advance. Acting early is not the same as acting right, and the market has spent generations proving that lesson to anyone willing to keep records. Early feels sharp. Early feels like foresight. It gives the trader a sense of being ahead of the crowd, and that feeling is intoxicating. But the market doesn't pay for anticipation. It pays for alignment. Price either confirms your idea, or it doesn't, and no amount of being early changes that arithmetic. I used to believe that the money was made by getting in first. That belief cost me more than any bad market ever did. Being early only matters if you're also correct, and correctness is not determined by what you think should happen. It's determined by what actually happens. How many times have you been early and watched price drift just far enough against you to shake your confidence before doing exactly what you expected without you? The trouble with early entries is that they demand faith. You're betting that the market will soon agree with you. Right entries don't require faith, they require evidence. Evidence takes time to appear, and time is the one thing an impatient trader resents. So he substitutes speed for confirmation and calls it skill. But speed is only useful when direction is certain, and in markets, certainty is always delayed. When you act early, you're trading potential. When you act right, you're trading behavior. Potential is cheap. Behavior is rare. The chart is full of almost breakouts, nearly reversals, and setups that look perfect until they aren't. Acting early means you commit your money before the market commits its intention. Why would you put your capital on the line before price puts its reputation there first? Most early trades are built on phrases like about to and looks like. About to break out, looks like support, looks strong. Those words don't belong in a business that settles accounts in cash. The market doesn't deal in about to. It deals in is or isn't. Either the level holds or it fails. Either the trend resumes or it doesn't. Acting right means waiting for the market to finish the sentence. Early entries also distort risk. When you enter before confirmation, your stop is based on hope, not structure. You give the trade extra room, just in case, and that room has a habit of filling up with losses. Right entries tighten risk naturally. They place you closer to invalidation, where the market itself tells you when you're wrong. Isn't that the kind of feedback you want? There's an ego component to acting early that traders rarely admit. Being early lets you say, I called it. Being right only lets you say, I followed it. One feeds pride, the other feeds the account. The market doesn't care which story you tell yourself afterward. It only counts the balance. How many trades have you held on to longer than you should have just to prove that you were early? Patience doesn't mean waiting forever. It means waiting for the right moment. The right moment is when risk is clear and probability is on your side. That moment rarely arrives at the first sign of movement. It arrives after the market tests itself. Breakouts get retested. Trends pause. Weak hands are shaken out. Early traders absorb that noise as pain. Right traders let it pass and step in when the path clears. Acting early often forces you to manage emotions instead of managing trades. You're constantly asking whether the market is about to turn back in your favor. You watch every tick. You negotiate with yourself. A right trade doesn't demand that kind of attention. It behaves as expected more often than not. And when it doesn't, it fails quickly and cleanly. The market is full of false starts. It moves just enough to lure in the impatient and then pulls back to see who really believes. Early traders mistake that first movement for commitment, but commitment shows itself in follow-through. Volume confirms, levels hold. Price accepts higher or lower ground. Those are facts, not feelings. I've found that most traders who insist on being early are really afraid of missing out. They'd rather be wrong early than right later, because missing a move feels like a personal failure. But missing a move costs nothing. Catching the wrong one costs real money. Which of those should bother you more? Acting right often means entering when the move already looks obvious. That makes people uncomfortable. They worry they're late, but the best trends feel obvious for a long time. They don't disappear the moment they reveal themselves. If a move is so fragile that it only works for the first few ticks, it wasn't a real opportunity to begin with. You don't get extra points for suffering through drawdown just to be early. The market doesn't reward bravery. It rewards timing, and timing is not prediction. It's recognition. Recognition comes from waiting long enough to see what the market is actually doing instead of what you want it to do. When you act right, you're calmer. You're not hoping. You're not defending a position. You're simply participating in a structure that already exists. That calm is not accidental. It's the result of letting the market lead. Acting early puts you in front of price, trying to drag it along. Acting right lets price pull you into the trade. The market never rushes you. Your emotions do. That truth took me longer to learn than any chart pattern or price rule, because it's uncomfortable to accept. It means the pressure you feel has nothing to do with the market itself. The candles aren't shouting. The tape isn't demanding action. The urgency is coming from inside you, and once you see that clearly, trading starts to look very different. Price can move fast, but speed is not the same thing as pressure. Pressure is psychological. Pressure is the feeling that if you don't act now, you'll lose something important. The market doesn't create that feeling. It simply reveals it. When price accelerates and your heart rate follows, that's not information, that's exposure. The market is showing you where your discipline is thin. Think about it. The market opens every day, whether you trade or not. It doesn't care if you're ready. It doesn't speed up because you're watching or slow down because you're confused. It operates on its own schedule. Yet traders constantly say they were forced into a trade. Forced by what? A moving bar, a flashing quote, or the discomfort of watching opportunity appear without permission. Emotions rush you because they hate uncertainty. Waiting leaves too much room for doubt. When you wait, you think. When you think, you question. And questions make emotional traders uneasy. So they act not to make money, but to end the feeling of uncertainty. The click becomes an escape hatch. Have you ever noticed how relieved you feel right after entering a trade, even before it works? That relief is temporary, and it's dangerous. It teaches your brain that action solves discomfort. Over time, you start clicking not because the setup is good, but because the feeling is bad. The market hasn't changed at all, but your behavior has. You've trained yourself to confuse urgency with opportunity. The calm trader understands something simple, nothing important in the market happens in a hurry. Even fast moves take time to develop. They leave footprints, failed tests, volume expansion, acceptance at new levels. If you feel rushed, it's usually because you're reacting to the first sign of movement instead of waiting for the story to unfold. Why assume the first chapter tells you the ending? Emotional rushing also shrinks your perception of risk. When you're calm, you see the full picture: entry, stop, target, context. When you're rushed, your focus narrows to the entry alone. You just want to be in. Risk becomes something you'll figure out later. But later is always more expensive than now. The market is patient by nature. It waits for liquidity. It waits for participation. It tests levels repeatedly before committing. When you rush, you're acting out of sync with the very thing you're trying to trade. You're sprinting while the market is walking. That mismatch is where mistakes are born. Most emotional rushing comes from fear of missing out, but that fear is based on a lie. The lie is that opportunities are rare. They aren't. Clean opportunities are rare, but those are the only ones worth trading. The rest are noise, and noise never runs out. The market will still be there tomorrow, next week, next year. Will your capital be there if you keep letting emotions set the pace? I've seen traders blame fast markets for sloppy trades, but fast markets don't remove your ability to wait. They just test it. If your plan requires rushing, it isn't a plan, it's a reaction. A real plan assumes time, not speed. It assumes that if you miss one trade, another will come when conditions align again. The strange thing is that emotional rushing often masquerades as confidence. The trader looks decisive, coactive. But inside, there's tension. The need to be right. The need to be involved. Calm traders don't feel that tension. They don't feel pushed. They feel selective. And selectivity is impossible when you're in a hurry. When emotions rush you, you stop listening to the market and start listening to your thoughts about the market. That's a subtle but critical shift. The chart becomes secondary. Your internal dialogue takes over. It's moving. I can't miss this. I'll just take a small one. None of those thoughts come from price. They come from fear disguised as reasoning. The market never asks you to chase it. Chasing is a choice. And like all choices in trading, it has consequences. The market rewards traders who let it come to them, who allow setups to mature, who respect the time it takes for probability to show itself. Rush trades rarely have that foundation. They depend on momentum continuing without interruption, and momentum is unreliable when entered emotionally. One of the hardest skills to develop is learning to feel urgency without obeying it. You can notice the impulse. You can acknowledge the excitement or fear, but you don't have to act on it. That pause, sometimes only a few seconds, is where discipline lies. If you can pause, you can think. If you can think, you can decide instead of react. Over time, you begin to recognize the difference between market speed and emotional speed. Market speed has structure. Emotional speed has none. One is observable, the other is internal. Confusing the two is costly. Separating them is profitable. Boredom is a hidden position and a dangerous one. Most traders don't recognize it as such because it doesn't look like risk. There's no entry price, no stop, no red number blinking on the screen. It feels harmless. You're flat. You're waiting. Nothing is happening. But boredom has weight, and it leans on your decisions in ways the chart never does. When the market goes quiet, boredom starts talking. It whispers that you've been waiting long enough. It suggests that you're being too cautious. It points out every small movement, as if it might be something more. The longer nothing happens, the louder that voice becomes. And if you're not careful, you'll trade just to change the feeling, not because the market asked you to. The dangerous part about boredom is that it disguises itself as readiness. You tell yourself you're alert, prepared, watching closely. But boredom isn't alertness, it's restlessness, and restlessness wants resolution. It wants action. The market, on the other hand, often wants time. That mismatch is where bad trades are born. I've learned that boredom usually sets in when a trader confuses participation with progress. He feels that if he's not in a trade, he's falling behind. The screen is on, the charts are up, but there's nothing to do. That emptiness feels like wasted effort. So he fills it. He manufactures a reason to trade. Have you ever taken a position just so the day wouldn't feel like a waste? Boredom lowers standards. Setups that wouldn't qualify on a busy day suddenly look acceptable on a slow one. Levels get wider. Rules get flexible. It's close enough, becomes good enough. And boredom is patient. It doesn't rush you all at once. It erodes discipline gradually, trade by trade, until you don't recognize the line you crossed. The market doesn't owe you excitement. That's a lesson most traders resist. They come looking for stimulation and find risk instead. Quiet markets are not broken markets. They are selective markets. They are filtering out traders who need constant action from those who can wait. Which group do you think keeps their capital intact? Boredom also creates false confidence. You've been watching for hours. You feel familiar with the price. You think you understand its behavior. That familiarity breeds comfort, and comfort breeds assumption. You start believing you know what comes next, not because the evidence is there, but because you're tired of waiting for it. There's a reason the worst trades often happen in the middle of the day, when volume dries up and nothing is clear. That's boredom time. The professional trader steps away. The bored trader leans in. One respects the environment. The other tries to force opportunity out of it. Flat is a position, but boredom turns flat into pressure. Pressure to justify your time. Pressure to feel productive. Pressure to make something happen. The market doesn't respond well to pressure. It responds to alignment. If alignment isn't there, the correct action is inaction, no matter how dull that feels. Boredom makes traders mistake noise for signal. A few ticks up look like momentum. A small pullback looks like a bargain. Without context, every movement feels important. But importance in the market is measured by participation, not motion. When volume is thin and structure is unclear, movement is just movement. I've seen traders sit through hours of nothing, only to give back a week of gains on one bored trade. Not because the trade was large, but because it was careless. Carelessness doesn't come from ignorance. It comes from impatience. And impatience often wears the mask of boredom. The disciplined trader understands that waiting is work. It's not empty time. It's observation. It's preservation. It's letting the market reveal itself instead of poking it to see if it's alive. That mindset turns boredom into neutrality instead of danger. You don't need to trade every day to be a trader. That idea alone would save most accounts. Markets move in cycles, expansion and contraction, activity and rest. If you can't respect the quiet phases, you won't survive the active ones. Boredom tempts you to ignore the rhythm and play when the music has stopped. There's also pride involved. Sitting out feels like doing nothing, and doing nothing feels weak to some people. But strength in trading often looks like restraint. The strongest position is the one that costs you nothing while you wait for conditions that justify risk. Boredom makes you negotiate with your rules. You don't break them outright. You bend them, just this once. Just to see, and once you do, boredom has done its job. It's moved you from observer to participant without permission from the market. The cure for boredom is not more trades. It's perspective. Understanding that capital saved is opportunity preserved. That a flat day is sometimes a successful day. That not losing is part of winning. The trader who accepts this doesn't feel bored. He feels selective.